Hello and welcome to today's quick video, which is called CPI, China deal announcement and Iran tensions. That's the subject of what had been yesterday's drivers, and we will put them into macroeconomic context because yesterday's session was not free from good reversals, sending stocks to predicted, described support levels, and there we are seeing some search for direction, all within the context of rotations that have had the predictable outcome and some sectors which did not gain particular traction. And I'm looking at financials and regional banks. Starting with this 15-minute ES chart, we see quite a few bumps to reclaim yesterday's highs that had gotten progressively slower during the course of yesterday's session, and especially when those Iranian tensions had come to the forefront, we had seen some quite fast selling. I will be linking to yesterday's video where I have been describing these support and resistance areas as well. I have been talking about the willingness to go down being quite fast, quite steep, and at that moment still reasonably soon rejected. However, this has thus far not happened within S&P 500, so I have to look into intra-sectoral and intra indices and inter-sectoral clues for greater clarity. And for now, rotations had been kind of saving S&P 500. Nasdaq had been comparatively weaker. However, if you compare today's pre-market session, this is not looking that bad. And if you check on the daily chart the percentages of stocks trading above various periods of their moving averages, the picture is not at all disastrous. For now, we are at the stage of seeing upswings, breakouts rejected. However, stocks are not breaking down. Yesterday, those 6,006 area had been one of those that had provided some kind of a cushion, and the level in 5,980s, which I had specified to swing trading clients yesterday, and that I had been covering within the update issued at 2 a.m. European time for intraday trading clients, that had been holding. So that leaves quite a few opportunities for stock market bulls, especially if we get cooperating data. However, what must be noted is that the announcement of the outline of the trade deal with China that is not yet put on paper, not yet finalized, but it's at a certain stage, at a certain promising stage, when it was announced by the American side publicly. So, even though the trade deal is far off, the goodwill that it generates and the confidence that it restores within the market should have held equities up. And it was a bit troubling that it did not happen, which was sometime before yesterday's CPI announcement. Stocks were marginally up, but not raging up, and there was quite a lot of volatility in the announcement involved as well. And I've already described the deterioration within the leading indices, and that goes as well for, if you look at Russell 2000, which had been running so great since the latter part of prior week. So there, within this one, I was ready to tolerate a bit more weakness for lasting a couple of hourly candle areas. Well, unfortunately, Russell 2000 is still underperforming, and I doubt whether this one would be the one leading S&P 500 higher, meaning that the 5980s level, which had not been reached, would have to hold, meaning that on this chart I would not want to see those lows broken to the downside, not even by 3 to 5 points of S&P 500 futures. Of course, that requires cooperation from the incoming data, and I'm not looking at just initial claims, I'm looking especially at continuing claims, which should not be trending higher and above 1930. That would be really a big hit, talking in thousands, of course. That would be a big hit to the job market perception. And when it comes to PPI, given that yesterday's CPI came at only 0.1%, if today's PPI comes in as expected or hotter, that would be a negative for equities, because that would cut into profits, into earnings going down the road. We want to see if companies are not being able to pass on higher prices to consumers, that they themselves are not being pinched and milked to accept higher prices, which would be seen in high PPI, and we are already having prior months negative PPI. So anything between 0.5 to 0 would be positive, meaning the deflationary wave, which is misjudged by the marketplace, would not be moving to the front burner, and yet the pricing pressure would not be as bad as to leave companies in a bad place. However, what had been the key movement, the key thing that had characterized yesterday's S&P 500 session? I looked for greater performance from interest rate sensitive sectors, meaning financials, regional banks, meaning as well real estate, meaning as well staples, meaning as well select healthcare names. And that's not exactly what we got in all those cases. So the picture is, as said already, one of upswings being rejected for now. However, there is not yet clear evidence of breakdown within the S&P 500 and going down to retrace a technically meaningful level. For now, this is keeping still above my area of specified to clients precisely 5980s, and I'm waiting to see whether not just the dividend stocks catch fire the way they did yesterday, but whether those more typical interest rate sensitive names would get their act together and would lead S&P 500 up. For now, what I can say, if you look at these two charts, the pre-market posture, meaning in Nasdaq not declining that much and being somewhat closer to yesterday's lows than S&P 500 is mildly positive sign, but it is a first swallow only and it has to continue. So it is about this data, how they would come out and how market would perceive that and whether they result in traction for more than a couple of opening minutes after the announcement, after the data announcement. So that's it for today, and let's talk more on Twitter. And of course, I will be foremost occupied with guides in the premium Telegram channels and on my site.